Banks profit tremendously off of almost everyone in America. Either they're lending you money to buy cars, real estate, business inventory, or equipment, or you're parking your money safely inside of one of their accounts so that hopefully you won't ever need any of their loans. Meanwhile, they're loaning out every single dollar of your savings multiple different times for a large profit while they give you pennies on the dollar for the use of your own capital. Either way, they win. This video will show you how to profitably run those exact same cash flows through your own private banking system to build two assets at once and get your money working for you. Now, in order to explain how to do this yourself, we're going to examine both of the ways that the banks profit by using the example of a real estate investor. Now, keep in mind, this exact same model can be used by business owners investing in their own business as well as financially responsible consumers. But first, let's take a look at the traditional bank financing for ongoing real estate. Essentially, you borrow against the property itself to qualify for the bulk of the capital necessary to acquire it. You then must make an ongoing structured principal and interest payment to pay off that loan to get yourself back to even though you want to invest in yet another property. So again, you have to prove not only your credit worthiness, but also the feasibility of the project you want the money for. So as long as you continue to steadily and make on-time payments back to the bank according to their terms, you should be able to hopefully continue financing your real estate empire. But be very clear about the fact that there is no guarantee the bank will continue to make this money available to you. If there is something going on in the economy or for whatever reason, the bank just doesn't share your same vision for the project, they can simply pull your financing at any time. And this is all the more reason to save your own cash so you don't need to rely on the bank. Let's face it, some people simply hate the idea of borrowing, even if it helps them massively acquire more assets. They would just feel better paying cash for every single property they own instead of borrowing from the bank. Well, in order to do so, you first have to save up enough capital in a bank account that earns very little to no interest. Then once you acquire that first property, you now own it free and clear without owing anyone. Now, even though you don't need to pay any debt service to the bank for the use of their money, if you want to buy a property in the future, you still have to continue making ongoing payments into one of their accounts, earning very little to no interest. That way, you'll have enough, when you have enough cash to make the purchase in the future, you can do it free and clear. And because of this, the payment structure you have already set up is nearly identical when you pay cash outright for every single property and then financing it 100% using bank loans. Now, some of you say, hey, wait, if I pay with my own cash, at least I don't need to pay interest for the use of the bank's money. That is true. But remember that you are passing up on earning a reasonable interest rate on your own capital by keeping it safe and accessible inside the bank account. In fact, you're voluntarily not gaining any ground whatsoever on this very large block of liquid assets between every single property purchase. Even if interest rates go up considerably, you wouldn't be able to take full advantage of it because as soon as you get your account to the point of deal funding, you kill the compounding curve every time you withdraw cash from your account to buy another. And it doesn't have to be that way. For the rest of this video, I'm going to show you how to create a money accelerator with your own bank by keeping your liquid reserve safely and continuously compounding for you, even though you have them out working for you elsewhere. You see, in a perfect world, you save up an asset one time and they go ahead and compound into the future. What's so powerful about compounding is that you not only earn interest on your principal, but pretty soon you'll earn interest on the interest through the principal already earned. It creates a very powerful snowballing effect. That's why the curve on the right is a lot steeper than on the left. In fact, when I ask clients which side of the curve would they rather have, everybody wants the steeper curve on the right. But you don't get that without putting in your time on the early part of the curve. You see, it's just about the time value of money. Keeping your assets continually compounding is very, very important. However, these purchases do need to be made, and every time you just reset your compounding curve to the very beginning, eliminating the ability to get the interest on the right. That is unless there is a contractual way to borrow against our assets at any time for any reason. You can see when we do, the red line comes down, indicating there's a lien against our assets. But notice that the entire asset continues to compound up the green curve. And as we pay down the lien against the assets, we actually end up at a higher place in the curve each and every time. That's really the biggest component to this strategy. The fact that your entire asset base continues to compound for you while using some of the money to make those purchases. Now, it also helps that the asset class we've chosen grows each and every year at a very positive rate of return. This contract also eliminates any market losses as well as any taxes. All these things work in your favor. Now, keep in mind that the cash flow and payment structure we're using is an apples to apples comparison with someone else that pays cash. The fact that you don't have your entire asset base compounded for you when you withdraw cash from the account to make a purchase, you need such an astronomical rate of return to make this work to overcome any taxes due, and it simply just pales in comparison to how effective the banking strategy can be. To learn more, text BANK to 872-269-8283.